All right, so let's look at chapter 5. What we'll do is we'll break this down between part A, B, and C. Today I'll do A. Tomorrow I will do B, and next day after that I will do C. Probably better that way. All right, so as you should know by now, uh, we're talking about revenues here. Some changes that were made recently. And so this is probably the first time you're hearing this. So you should have some idea of what revenues are. They're inflows or other enhancements of assets of an entity or settlements of its liabilities, such as a discharge of debt owed, or a combination of both, from delivering or producing goods, rendering services, or other activities that constitute the entity's ongoing major or central operations. And so a big part of this is determining how much to recognize, but almost as important is recognizing when, or understanding when to recognize revenue. What you probably have learned in the past is that the realization principle was in effect, which stated that revenue was recognized when the earnings process was virtually complete and there was a reasonably certain idea as to the collectability of the assets to be received. There was no doubt as to the fact that they were going to pay you. There were some problems with that. If you recall, we have this conceptual framework that we talked about in, I believe, chapter 1. And so this revenue recognition principle, realization principle, really didn't fit with it. And under the realization principle, they had all these different instructions for different industries on when to recognize revenue. And complex arrangements that involved multiple goods and services may or may not fit into any of those uh, guidances as far as the different industries. And so what they did was created the Accounting Standards Update 2014-09 called Revenue from Contracts with Customers. And so what this does is provides a one-stop area of guidance for all businesses in all industries in which to determine revenue recognition. So the core principle here is that the company recognizes revenues when goods or services are transferred to the customers for the amount the company expects to be entitled to receive in exchange for those goods and customers. So is there a big difference between this and the recognition principle? I don't think so, but you be the judge. So when do you recognize revenue? When you transfer a good or service to the customer. How much do you recognize? Well, whatever you're entitled to receive. I don't see a big difference. The big difference may come, when you provide one good, one service at a particular time. I don't think there's any doubt that revenue recognition principle and this ASU 2014, not good with numbers, '09, remembering numbers of, things, section number, blah, blah. 2014-09 is what it is. When you provide multiple goods or services at different times, that's where you might have some issues, and that's where this 2014-09 seems to be a little more little easier to administer that sort of situation. All right, so it talks about under the 2014-09 there being a 5-step process for applying the principle of this new principle of recognizing revenue. And so first thing you have to do is identify the contract. Second, you have to identify each performance obligation under the contract. You have to determine the transaction price. And then you have to allocate that transaction price to each performance obligation. And then after that, you recognize revenue when or as each performance obligation is satisfied based upon the allocation. So as far as identifying the contracts, just realize that this revenue recognition process doesn't start until a contract has been entered into by the buyer and seller. Until that point, you don't even consider any sort of revenue recognition. And again, think back to your business law. Understand that a contract can come into existence even without a writing, as long as the parties have agreed. Certain contracts do require a writing, but most contracts don't require a writing. So a verbal agreement can be a contract. Next, you have to look at the performance obligation. And it's a good idea to determine whether or not you have a single performance obligation or whether or not you have multiple performance obligations. If it's a single performance obligation, it's somewhat easier, especially if you're providing the good or service at one point in time. Sometimes you have a single obligation, but you're providing the service over a period of time. A little bit harder, but not that difficult either. What is difficult is when you have multiple obligations, multiple different obligations. So that's when you have to do this allocation. All right, so we have a concept checked. Which of the following is not a step used to apply the core principle of revenue recognition? Well, A is true, B is true, and C is true. So D is the loser or the winner, however you want to look at it. So let's look at recognizing revenue at a single point in time. Pretty easy. What you have to do here is look to see when the customer, the buyer, has control transferred to them. And so they list 5 different indicators of when the customer has control transferred to them. One would be when the customer has an obligation to pay the seller, and you can get more than one of these at the same time. When legal title has been transferred to the buyer, when physical possession of the asset is in control of the buyer has assumed the risks and rewards of ownership, they're actually using it, the buyer accepts the asset. Doesn't indicate that they're somehow rejecting the asset, is another way of looking at it. The more of those you have, the more likelihood that control has been transferred to the customer. I'm not sure any one of those is a controlling factor, though. You know, if there becomes a dispute that whether or not the customer actually owes this, who makes that decision? Well, a court. And at that point, they're going to look at all the factors, and the more factors that are met, the more likelihood that the customer owes it. All right, so here we have an example, and it's kind of a running example. TrueTech Industries sells the TriBox, a game console that allows users to play video games individually or in multiplayer environments over the internet. A TriBox is only a gaming module and includes no other goods or services. When should TrueTech recognize revenue for the following sale of 1,000 TriBoxes to comp stores? So here we have our first event. On December 20th, 2017, Comp Stores orders 1,000 TriBoxes at a price of $240 each, promising payment within 30 days after delivery. So all they've done is ordered these TriBoxes. No delivery's been made. They don't have control over them or anything like that. Physical possession is still in the hands of Comp Stores, or excuse me, TrueTech. So Comp Stores have received nothing at this point. couple of weeks later, January 1, TruTech delivers the 1,000 try boxes to comp stores entitled to the try boxes transfers. Well, at that point, we make an entry for the 1,000 try boxes that are delivered to comp stores at $240 each. So you debit accounts receivable, you credit sales revenue. On January 25th, TruTech receives $240,000 from comp stores. Well, we recognize the cash and back out the receivable. All right, so here's a concept check. Which of the following is not a key indicator used in deciding whether control has passed from the seller to the buyer? So A is true, B is true. Is B true? So actually, looks like A is not true, because that goes to step 1. That's kind of tricky. Which of the following is not an indicator that control of a good has passed from the buyer to seller? Buyer has scheduled delivery. They don't have the goods yet. All right. Gets a little trickier when you're recognizing revenue over time. So you recognize revenue over a period of time if one of the following 3 conditions are present. Number 1, the customer consumes the benefit of the seller's work as it is performed. And so their example is cleaning services. If you have a 6-month contract for a cleaning service, you're going to recognize revenue each month over that 6-month period. Number 2, the customer controls the asset as it's created. Let's say an extension to a hospital is being constructed. As parts of the extension become complete and controlled by the customer, then revenue will be recognized over a period of time for that piece that's constructed. We'll look at that and how we do that in part C. Number 3, the seller is creating an asset that has no alternative use to the seller, and the seller has the legal right to receive payment for progress to date, even if the contract is canceled. So their example is an order of jets customized for the U.S. Air Force. Wind turbines might be another good example, things like that. So if one of those following 3 conditions exist, then revenue is going to be recognized in proportion to the amount of the performance obligation that has been satisfied. So for example, just a real easy example of that second condition. You complete 40% of the building, and the customer controls that 40% after it's built. Then the builder is entitled to 40% of the contract amount. All right, so here we have an example. Excuse me, TrueTech Industries sells a 1-year subscription to the TriNet multi-user platform of internet-based games. TrueTech sells 1,000 subscriptions for $60 each on January 1 of 2018. Okay, so these are 1-year subscriptions. They sell 1,000 for $60 each. So they get the cash, but because it's a 1-year subscription, they have to defer that revenue. So debit the cash, credit deferred revenue, $60,000. And then each month, what they're going to recognize is 1/12 of that 60,000. So that's what that looks like. What happens if none of the 3 criteria that we just talked about apply? Then in that case, you're going to have to recognize revenue at the point in time when the performance obligation has been completely satisfied, which is usually at the end of the contract, or maybe even, they've satisfied the performance, but the customer has even a little more time before they pay. But for the most part, it's end of contract. If you are recognizing revenue over time, there's a couple of ways that this is done. Again, we'll look at this in part C. One method for determining progress is an output-based estimate, which measures the proportion of the goods or services that have been transferred to date. The second way that this can be done is an input-based estimate. This is where you measure the proportion of effort expended relative to the total effort that's expected to completely satisfy the performance obligation. So here's another concept check. Which of the following is an indicator that revenue for a service should be recognized over time? Looks like D is it, right? No, A. That kind of got tricky there with the wording, because that definitely looks different than what's in the book and was shown earlier on the screen. Tricky. All right. If you have a contract that has multiple performance obligations, then what you're going to need to do is look at steps 2 and 4, identifying the performance obligation and allocating the transaction price. That shouldn't be too hard to do in step 3, to allocate those to each the transaction price to each performance obligation. And so, as far as identifying the performance obligation, and so it says that sellers account for a promise to provide a good or service as a performance obligation if the good or service is distinct from other goods or services in the contract. The idea of separate contracts into parts that can be viewed on a stand-alone basis. So the idea is to separate contracts into parts that can be viewed on a standalone basis. That way the financial statements can better reflect the timing of the transfer of separate goods and services and the profit generated on each one. Goods or services that are not distinct are combined and treated as a single performance obligation. So what does it take for a good or service to be distinct? Well, you have to have two things. Number one, it has to be capable of being distinct, and two, it has to be separately identifiable from other goods or services in the contract. So the example they use is buying lumber, paint, and other building supplies for a home project at Home Depot. All those different things are capable of being distinct because you buy them individually and use them however you desire. Now compare that with a construction contract for a home to be built, and their example is Toll Brothers, which I don't think they build up in this area, but whatever. You know, you're not looking for lumber, paint, roofing as distinct items. You're looking for a dadgum house. So in that second example, the only thing that's distinct is the single performance obligation of building a house for the buyer. So here we have an example. TrueTech manufactures the TriBox system, multiplayer gaming system allowing players to compete with each other over the internet. So again, the TriBox includes the physical TriBox module as well as a 1-year subscription to the TriNet multi-user platform. So they're combining the two examples before into one thing, so they're sold as a package deal, but they could have sold them separately, right? So you get the 1-year subscription and the module in this package. TruTech sells the individual 1-year subscription, as we saw, for $60, and the module for $240. As a package deal, they're selling them together for $250. So we have to allocate that $250 to the two distinct performance obligations, the 1-year subscription and the module. So how do we do that? On January 1, 2018, TruTech delivers 1,000 TriBox systems to comp stores at a price of $250 per system, and they receive $250,000 from comp stores on January 25, 2018. So first thing we have to do is identify the performance obligation. So again, we have to determine whether or not a good or service is distinct. And here I think we definitely realize that we've got two different things here, the module and the subscription. So there's two performance obligations here. And so we have to allocate this $250,000, the $250 per system, to the two performance obligations. So that brings us to step 4. So we're going to take the transaction price and allocate it among the module and the subscription, are two performance obligations. Well, how do we do that? Well, we have to figure out, based upon what they would be sold as separately. You would sell the one item for, what was it, $240, the box, the module, and the subscription for $60. Well, together that's $300. So if you allocate the $240 of the $300, that's 80%. So 80% of $250 is going to go to the TriBox, and then the other 20% of $250 is going to go to the subscriptions. The thing here is that the TriBoxes have been delivered, so that amount, 250 times 80%, which is 200, is going to be recognized immediately, since the TriBoxes have been delivered on January 1. And then the other 50,000 has to be deferred, since it's a 1-year obligation. So let's show you how that happens. So again, look at what they've done. They've taken what you could have sold these for separately, $240 and $60, which is $300 total. You divide the $240, the first amount, into $300, that's 80%, and then the other $60 into $300 is 20%, and that's going to be your allocation base for the $250 transaction price. So here we recognize sales revenue on the TriBoxes of $200,000, the deferred revenue of $50,000 is your other credit. And then each month you're going to recognize sales revenue for 1/12 of the subscription price of $50,000. So not too difficult, not too bad. All right, so here we have a concept. Allen Company wrote a contract that involves two performance obligations. Product A has a standalone selling price of 100. Product B has a standalone price of 200. The price for the combined product is 240. How much of the transaction price should be allocated to the performance obligation for delivering product A? Well, that looks like that would be 1/3 of 240, because the combination of 100 and 200 is 300. So 100 into 300 is 1/3. So you take 1/3 times 240. So you got 80, right? All right. So tomorrow, part B, special topics in revenue recognition.